Welcome to the Rise Network podcast show, a podcast dedicated to help you reach your dream lifestyle through investing in real estate. We're going to be sitting down with new, intermediate, and experienced investors to talk all about real estate and how it has changed their lives. If you're looking to scale your portfolio or even just get into real estate investing, you're in the right place. Make sure to tune in. Hello, everyone. You are listening to the Rise Real Estate Investing podcast with your host. Oh, fuck. It's my name first. With your host, Austin Ye.
And Mayu. What's going on, everybody?
Sorry, guys. My brain is completely cloudy and foggy right now. If you follow me on social media, I've gotten a puppy recently. And for anyone who ever has gotten a dog, on puppy stages, they just keep you up all day and night. So I've just been mentally drained and exhausted. So the first week this first week, I would say, is a pretty significant break from real estate, even though I am still on and off. But my brain's just not functioning at full capacity right now.
Damn, it's not like you just had a kid, man. That's pretty rough.
It basically is like a precursor to a child. Yeah. How's everything with you, Mayu?
It's good, man. It's good. The past week was more so just mortgage files that we were getting through. The flip on my end, the
mortgage files. Okay, so you've taken now it's like full steam ahead on the mortgage agent side, right?
Yeah. So now it's full steam ahead on the mortgage side. I gotta figure out my social media calendar. We'll see what kind of educational videos I do on mortgages, because that's something that we don't talk about enough there. But yeah, that's basically replacing 9 to 5 is the mortgage side. The flip in Tiny Ontario finally sold yesterday or on Monday or something like that. That one was interesting. That we listed at $499. We thought market value was about like $550. We thought aggressively if we were above $550, that's a big, it's a really good offer that came in, right?
Okay, hold on. That $550, was that after market depreciation? You were like, oh, since the market appreciated, it should be $550, or is that like even before it could have reached $550?
Before it would probably the cottage market was always pretty hot.
Oh, true.
I think ever since we bought it, I think in February we tried listing it at 400 just to see if we could sell it without doing any work. And at that time, the estimates that we had was like 500 to 550 as well. So we weren't far off. Mm-hmm. Anyway, so hitting anything above 550 was like shit. Like we're really lucky. Anything above 500 was like, okay, that's kind of like a fair offer, like 500 to 550. And then anything below, I was like, I'm not going to sell it under 500. So we listed at $499. Crazy amount of showings. I think what happened with this cottage is really close to our neighboring property, and as a result, no offers on offer day.
So it's not secluded, eh? It's just kind of there's neighbors on both sides.
There's neighbors on one side, and then it's a corner lot, but still, it's like a pretty small lot, right? But it is the cheapest cottage in cottage country. Even though it's fully renovated, it's still not that expensive. It's not waterfront. It's not a huge lot, things like that. But if you kind of think about who's coming to buy a cottage, it's not people that are probably price sensitive between 500 and 700, right? And if on 700, if you can get the big lot or with water views or something like that, you're probably going to go for that, right? So I think that was the main hurdle that we had to overcome. But I don't know, it was a good learning lesson. And then basically the offer came in and the guy wanted 500 for it. And then it was just a negotiation game, but his offer was super clean, right? Closed within 30 days, $50K deposit, no conditions. So I was like, honestly, I'd much rather just work with this guy and get this thing done than I would wait for someone else to come, have a condition of inspection, give that 2 weeks, do it again, and so on, right? This way, at least we can start looking for another flip to close near the end of July. That's ideal for us, right? So yeah.
That's awesome. So in terms of, we always talk about the market kind of easing off in terms of offers. Is that something that you've noticed as well, and something you're going to be more cognizant of moving forward on your flips?
100%, man. I think you and I talk about this quite a bit, but I think we had a lot of showings. I think there's it's a pretty consistent sentiment. Whatever market realtor you talk to, for the most part, they'll all say that the same properties that used to get 10 offers now get 2 or 3 offers, right? Mm-hmm. I think people are just tired. As things open up, now it's summer. I think we're having a reverse effect of how it used to be a few years ago, where in the summer, the housing market was, or spring, the housing market was crazy. And then summer, it stayed kind of consistent with that. And towards the end of the summer, it picks up, right? But I think now, lockdown, so everyone had nothing else to do but look at real estate. Now things are kind of opening up. The weather is improving. I think people are just moving on. They're tired of constantly hunting for a house. And if they have that option to defer it, they're just deferring it. That's my complete estimate. But yeah, I mean, what are you guys seeing on the wholesale side? I'm sure even the off market, you guys are kind of feeling that effect too, right?
No, so on the wholesaling side, a lot of sellers are they still want top dollar. Nothing has changed from the seller's point of view. And the reality is that market dynamics have kind of shifted. So we want to lock things up at, better prices, even though prices haven't shifted drastically or anything like that. Pretty much not really at all. But the sellers still want that top dollar, right? So we're just being more cognizant on that side.
Yeah. So I always have a theory that the off market runs on a lag from the MLS, right? So when you're in an upward market, sellers don't really know what their properties were today because they're using historical data that's maybe 2 to 3 months old. And then when you're in a downward market, the sellers refuse to accept that you're in a downward market, and they're listing off comps from
they're I can do a better job than their realtor. It's basically what they think. It's I want to save on commission fees and I still want top dollar, and it just doesn't work like that off market. Mm-hmm.
Yeah. So you guys locked up a deal as well recently, right?
Yeah, we locked up a deal. We have a 6 units that is closing today in Sudbury. We also had we have an 8 unit that we closed on a while ago, and we kind of just left the occupants in there. But I had cash for keys conversation last week before the puppy came because I knew that was going to keep me busy. Fortunately, was able to negotiate 4 out of the 8 tenants to leave, and I think I should have success negotiating 1 more for a cash for keys offer. And then we have a duplex that we're finishing renovations on. 1 unit's tenanted. I was able to convince that tenant to move to the completed unit in the back temporarily while we finish her unit. Then I'll move her back to her unit and have an increase in rent. And she's totally okay with that. So she's going to be paying 95% of market rents. I couldn't get it to the full 100, but still that's a huge W, right? Because I'm not paying leasing fees now. So I actually save money that way. But that's been keeping me busy, man. The cash for keys conversations is never an easy one. And it's always so exhausting. You just never know what you'll get in those conversations, but it's about staying calm, understanding the other person's perspective. One person just came out guns blazing when I went into their unit, came out and started just yelling at me almost instantaneously. I was like, oh shit, I've never dealt with that. Usually it's a pleasant, hello, how are you?
How was she yelling, or he?
Yeah, so he overheard me have the cash for keys conversations with other tenants. And then as I went to his unit, it came out and just buck wild and just started going crazy on me. And I was like, okay, this is obviously not a good start. But was able to remain calm, have a conversation with him, let him settle down. And he agreed to sign the cash for keys for him as well by the end of it, which, that was the biggest W. Oh, man, I impressed myself on that one, not going to lie. But, I mean, that's what we're going to be working on, wrapping that project up. But anyway, so I know that's a very popular topic. I don't know, maybe we should have an episode on that. There's a person named Adam Kitchener. We should have him on. I know he's a pro at that. But that's neither here or there. We're going to jump into today's podcast today. And I'm very excited for this episode. Today we have Stephen Huang on, and Stephen is quite an interesting investor. He actually lives out in British Columbia, but he invests ultra long distance down in Moncton, which is in New Brunswick. He's actually a newly graduated dentist, long distance investor. He's also invested in the US. He primarily does multifamily properties with value add renovations, turning around tenants and increasing rent. And Stephen was actually gracious enough, even before this podcast, to jump on a call with Mayu and I to just give us the one-on-one breakdown about the New Brunswick market. And today we're going to kind of be doing the same, getting into his journey and then learning a bit more about the Moncton market and how he makes numbers work. So this is an episode you definitely don't want to miss, especially if you want to invest long distance. Make sure to tune in. Hey everyone, we are joined with a guest that I'm very excited to have on. It's gonna be, I kind of know your background a bit, but I want the audience to hear it as well because you're doing some pretty cool stuff. We're joined with Stephen Huang. Stephen, how are you today, man?
Yeah, I'm doing great, Austin. Thanks for having me on here, and it's good to see you guys in person.
Awesome, Stephen. So I know myself and Austin chatted with you a few months ago, but for everyone that might not know you already, what's your background? How did you get started in real estate? What do you do? All that good stuff.
Yeah, totally. So a bit about myself. I'm 26 years old. I'm from Vancouver. I'm probably by the time this podcast comes out, I'll get my license to start working as a dentist. So I just recently graduated from UBC. I spent 8 years in the Canadian Armed Forces as a reservist, and I started real estate investing in 2012. When I first got started, I went down to the US and started buying some foreclosure properties. Now I deal mainly in multifamily properties out in New Brunswick. And currently, the portfolio I have is about 54 units across 9 buildings, and we got another 12 under contract. So that's sort of a 60-second summary of who I am and my background.
You have another 12 buildings or another 12 units under contract?
12 units. Not 12
oh man, I was like, both are super impressive. Wait, you said, okay, so you're 26 now and you started investing in
2012.
Yes.
Yeah.
Did you just you just finished high school?
So I was in my last year of high school and I was 17. So I don't think I was legally allowed to sign on anything. So, if you want to get into that, like I joined one of those guru mentoring coaching groups. And at the time they were teaching Canadians how to go down into the US to buy like foreclosures, right? So we started out in Phoenix, Arizona and Atlanta, Georgia. And I say we is myself and my brother, who was 2 years older than me at the time. So yeah, we were youngest people in the crowd. Everyone was average 40s and their 50s. But it's a good game to get into and everything just made sense. So that's how we got started.
Let's talk about that experience a bit. I want to dive down into what attracted you to the States, and are you still investing in the States? And when you kind of started investing in the States, how was that journey like? Because you were only 17 at that time. Oh, and we should make mention, you are not in Toronto, actually. You're in Vancouver, right?
Yes, I'm in Vancouver, BC. And I've been here the whole time that I've been doing this. So why did we get started in the US? Well, back then, like the investments, it just kind of made sense to go down to the US because at the time, the Canadian to US dollar, we were close to par. And then they were just coming out of the great financial recession, right? So there was a ton of foreclosures that hit the markets starting in 2009, 2010. So when we got in at 2012, it was just starting to come back. So we were buying buildings for about $30,000 a door to $50,000 a door, getting something like $700-800 a month per unit in rents. So back then it was like 1% rule all day, sometimes close to 2% rule, right? So obviously things have changed. But then, so things just made sense in terms of a cash flow perspective down in the US compared to where I live in Vancouver, where $1 million can't get you anything that's, not part of the condo tower.
So, okay. So I Googled from BC to Arizona or Phoenix because I had no idea how far it was, but that is nowhere near BC. So why did you go to why did you go to Phoenix to do your investing? How does the financing work for the US? And I know you're not doing the US side now, so we won't go too deep into it, but I'm sure you're right out of high school. Your brother's only like a couple years older than you or something. So it's not like you guys are flush with capital or something like that. And I'm sure investing in the US, like now you don't even meet like the big 5 bank like criteria. It's like, what did you have to do? Like, how did you get around those hurdles?
Right. So that was the biggest reason that we're not still investing there is because of financing. So obviously when we first started, we had to go to the bank of mom and dad. So it was borrowing funds from family and we bought everything cash. So we couldn't get financing from the bank, but because of how low the price points were, it just made sense, right? You could get like a 7-8% cap. Your cash on cash would be about the same, but then it just made sense. Why we chose Phoenix? Well, back then, how that coaching group worked was they had a couple in-person events at different markets in the US. So one of the day or like 2 of the days we'd spend at like the convention center and they'd have talks and presentations all day. And usually the day after is we just go and drive around the neighborhoods with some local agents. So then we basically got handed a deal package. It was a $100,000 duplex. The owner was actually offering 80% seller financing on it at like a 5% interest. So then we ran the numbers. We're like, hey, we'll get $1,200 a month in rent, $100,000. Everything we were taught so far, it just made sense. So being naive 17 and 19-year-olds, we just believed the spreadsheet. So then we just jumped right in and offered on the property and got it. So that was our very first deal. And then afterwards, because the coach that we were working with, she was investing in Atlanta. So we just piggybacked off of her sort of team that she knew, her managers that she introduced us to. And we just started investing heavily there. So that's Atlanta, Georgia.
That's awesome. So I love one key learning lesson there is that you kind of invested in yourself, and as a result, you got connected with local investors or people who had Power Team set up. So a lot of people ask, like, how do you even have the nerve or confidence to invest long distance? Well, you need to know the right people. In this case, you did know the right people to have those systems set up. And okay, so you grew your portfolio a bit in Atlanta as well. When did you decide to make a pivot? Are you still holding those properties? Like, what kind of change? Because now I know you're in Moncton, which we'll get into a bit later.
Yeah. So basically, from about 2012 to 2014, 2015, we were actively buying basically whatever we can get our hands on because, everything was just making sense on the spreadsheet. So we just blindly followed the spreadsheet. We stopped buying mainly because we jumped completely headfirst into the market and we didn't get our operations down well. So we ran into much higher vacancy than what we had projected, right? So it took one or two managers that we had to go through before we found someone that was, like a rock star and just kept vacancy basically at zero. So then basically at that point, we had probably 20 something doors across multiple like single family duplexes, triplexes, and fourplexes. So then we just decided, hey, we put in a ton of money since we bought it all cash. We've heavily leveraged ourselves and borrowed from friends and family at this point. Let's take a pause. Let's get everything solidified with our operations and then eventually maybe get back into it. Right. So, and also during that time, I ran into one horror story with a 5 units. It was my first exposure to something that was 5 units and up. But basically, all the nightmare situations happened, right? The zoning ended up not fitting. We were only allowed 4 units on the 5 unit. The contractor stole our money and ran away. It just turned into a whole nightmare that kind of turned me off real estate for a couple of years. So between 2015 to 2018, I just completely stopped buying anything new. We just held on to what we had, continued to cash flow it. And then sort of closer to 2018 was when I thought, hey, I want to get back into real estate, but this time I want to go bigger. I want to get some big multis, but also because of financing, that meant I had to look in Canada. Okay. So I ended up looking across the country. I actually initially wanted to go to Edmonton, but then, I even put a building under contract there. It was a 12-unit building. I think they were asking $114,000 per door. When I was running the numbers, I was like, I'm very conservative when I run my numbers. So this one was coming in at a cap rate of, they were saying that this was a 6 cap for the way I ran my numbers properly. And when I got their actual financials, it was coming in at like a 4.5% cap rate. At the time, the interest rates were like 3%. And then I was talking to this mentor of mine who was also a dentist at my school. And then I just happened to find out that he was in real estate and I ran this deal by him. And then he told me that, hey, like I invest out in Halifax. And back there, I was getting like 6% cap rates. So the spread was much better. Whereas in Edmonton, if I was only getting like a 1.5% spread between the cap rates and interest rates, like if interest rates even move in the wrong direction, it's, I could be in a world of hurts. So I ended up walking away from that deal and then happened to stumble upon New Brunswick because there was a friend of mine who was going to school there and he just made an offhand comment that, hey, there's this duplex that was really cheap there. And I was just like, oh, I didn't even know what cities were in New Brunswick except for Fredericton, right? Yeah. So I ended up just going on Bigger Pockets. I messaged a couple of local guys, reached out, asked them for some referrals, so maybe like an agent or a property manager or two, just did my research. And then sort of just realized that, hey, it was possible to find a cash flowing market that had similar numbers to what I found in the US, in Canada. So then I kept looking through the market, eventually put in an offer on a 12-unit building. And when I got it on a contract, I then flew out there to do the due diligence and meet the whole team. And then that was sort of how it kicked things off in 2018. And then we kept going from there and bought another 8 buildings.
When you were investing in Arizona, because I just heard you say that you flew out to New Brunswick. When you were investing in Arizona and Georgia, did you fly out there a lot, or were you more how often did you go down there?
So we never, except for the very first deal where we walked through it with the agent before we put in an offer on it. Every other deal we bought in the US, we bought sight unseen.
Oh, okay.
Right? And that was sort of part of the whole system that this coaching group was teaching us, right? That we can buy these properties sight unseen using local people on the ground. So we just hire an inspector, hire contractors to go through during the due diligence period. They would give us all the photos and videos that we needed to make a decision. And then, the lawyer does their legal due diligence and then we just close on it. And then we hand the keys over to the contractors. Property manager takes over. So it was very, very hands-on.
Let me ask you this then, because
I know myself and Austin, we're more so like doing this approach now as well, right? And I know you said you got burned by the contractors and things like that. That kind of happen post-close, like vacancies, all that stuff is a post-close problem. But did you have any, like, did an inspector ever lie to you? Did a realtor ever lie to you? Did you get like misled? Was there any problem with like buying properties essentially kind of sight unseen?
So far of all the deals we've done, so we never had issues with the agents lying to us or the inspectors like outright lying to us. I had one like a couple months ago in New Brunswick where he missed aluminum wiring. So I've kind of sworn off using inspectors now. I just send in the actual trades to do inspections. Mm-hmm. But the only person that, it was the same contractor. He was also the guy who wholesaled me the deal. So basically, because he had given me a single family home deal that turned out okay, I kind of went on trust on this next deal and didn't do the proper amount of digging. And then when things got tied up with the city, he then eventually just ghosted me. So that was the only instance where I ran into issues. And I usually find that if you want to be a long distance investor, the biggest issue you're going to have is with contractors. Right. Even when you're already there in person, it's already hard enough to manage them, to make sure they show up on time, get everything done, make sure they're not juggling multiple jobs. Right. That's already a pain in the ass when you're in person. So when I'm doing this from far away, where I can't verify the actual scope of work, is it actually as bad as what they said it is? It just makes things way harder.
So let's get into that on the contractor side, because you're doing these big multifamilies. Obviously, the renovation costs aren't cheap. And like, it's easier for a contractor to lie on a scope of work with the multi-family building than it is a single family home, right? So what are some systems that you have in place now to ensure renovations are done to the quality that you're looking for, shortcuts aren't taken, and your contractors are doing things in a timely fashion?
Yeah, sure. So basically, my whole business depends on the the property manager super heavily. Right? So they're the hub of my wheel. And basically, I base everything off of the property manager, right? If I was going to a new market, I know a lot of people, they give the advice, if you want to go to a new market, you find a investor-focused agent first, and then they'll refer you a team. For me, I actually prefer to go off a rockstar property manager, right? Because at the end of the day, besides from the acquisition side, the property manager is the one that's going to ensure the success of your deal. So when I have these renovation projects going on, I basically send in my property manager and the contractor together during due diligence, and they walk the building together. So she's the one who's telling the contractor, hey, I want this done, I want this done, and I want this done. So she's also the one, when the job is complete, who goes back in to, like, as she's going there to take all the leasing photos, she's also criticizing their work and pointing out all the flaws that need to be done. And this just happened like in the last week, right? So I've been using the same contractor for the last basically 9 months, right? And he's done a fantastic job. But even though he's like a really switched on dude, he still like forgets things, or he has his own subs that drop the ball, right? So we recently had a basement unit that was finished. I haven't posted anything about it yet, but he sent me a text and said, hey, it's all done. And I was about to kind of, because we've done so many renovations I was already ready to send him the e-transfer for the last bit of funds I was holding back. I just said, okay, but you know what, just hold on. Let me get my manager, Amy, to give me the thumbs up before I send it. And she went in, she's like, no, man, like the loft unit, he did awesome. But this one, like the paint looks like shit. He's got like patches in the closet where he didn't finish up. It's not done. So for me, I depend on the property manager to verify that for me, right? So the way I run my business is I believe in the phrase trust but verify. And then so it always has to be two different people who does it, right? So especially on the contractor side, my manager is the one that's watching.
Yeah, I know that makes a lot of sense, right? Because your property manager wants to get you top rent. They want to get a good quality tenant, because if they can't, they're making their own lives harder.
Exactly.
Right?
Exactly.
So they want the best quality possible. So they're obviously going to be picking and looking at any mistakes or any changes or any recommendations on the unit. So that's genius. Are you paying your property manager extra for doing all of this?
So I thought she was going to charge me extra, but she just seems to love to do work. So sometimes I'll ask her, hey, can you just drop by the building? And she'll just say, yeah, I'll do it. And then it's really close by. So she doesn't charge me extra. They just charge me a fixed, like a monthly like percentage off of rents collected. And also what's nice is because myself, I have so many units with her, and my brother also has built his own small portfolio in Moncton. Between us, like we probably make up almost 20% of their company's business.
Wow.
So when we ask them just say, hey, can you check this out? She doesn't mind.
Nice. But you wouldn't be opposed, like if you're entering a different market, you don't have that relationship with the property manager, you wouldn't be opposed to pay them for that kind of small.
Like if someone's doing an important job for you, I would absolutely pay them for the time, right? If they're spending, say, half an hour there, pay them $50, $100 even, if they're going to be really diligent for you. And
that's an important point. Just don't be cheap about it. And too many people are just cheap about saving like dollars, you know?
Yeah.
I also think what we're doing on our end with like renovations and like improving the overall quality of the building is making the property manager's job a little bit easier, right? Whether it comes to releasing it out or less turnover or the good quality tenants, all that stuff, it's because we're renovating it, we're improving the quality, right? And a lot of the times I'll be like there's a tenant turnover and I'll be like, okay, so like, what do we need to renovate? And they'll be like, no, I think it can be renovated as is. But I'm like, what do we need to do to like make sure that's like top quality tenants, right? So we are like kind of going above and beyond to produce that good quality product, right? So let's talk about kind of what you're doing in Moncton today, because I don't think we dug too deep into that. We stopped at where you bought your first multifamily, which was a 12-plex. Is that right?
Yes, that was the first big one that I bought.
Moncton, yeah. Okay, so then when was that? And then how did it go from there? Like what was the challenges that you dealt with your first building? And then what have you continued to do since then?
Sure. So with the first building, it was a 12-unit, like purpose-built apartment building. So it was all brick on the outside. It's a brick facade. And
but I love your brick buildings.
Yeah,
much better than vinyl and aluminum.
Yeah.
It also looks really nice, eh?
Oh yeah,
they do. Especially if you go in and do like a new paint job on the outside, like you will stand out from all the other competitors. So basically, it was 11 units, are 2 beds. One is a bachelor unit. All the rents when I came in were approximately around $750 to $800 with heat and lights included, so power hydros included for them. And my plan when I went in was just to basically do a slow burr. It wasn't going to be a perfect burr where I pull out all my equity that I put in, but it was going to basically, I was just going to increase the income, try to decrease the expenses where I can, and then refi in 3 years. So right now with that building, we're about 1.5 years into it. And we've gone through and renovated 8 of the 12 units. And with the remainder, we've already pushed their rents up to a level where I'm happy not renovating it because they're willing to pay more. And with the building, so when we first bought it, what we did was we sent all the tenants a 3 months notice that the rent was going to increase to a new level. And the purpose of that is to, one, weed out the bad tenants, because a lot of them who've been in there for a long time, like they don't want to pay, or if they've been late on paying, once they get an increase, they just bounce. So after that, after sending out that notice, we had about 3 units come vacant immediately. So I was able to immediately start turning over those units. And then the goal was basically, as each unit turns over, I would go in and renovate it. And as each unit becomes complete with the work, I was actually going to ask one of the existing tenants if they wanted to move into the new unit at perhaps a higher rent. None of them actually took me up on the offer, which was fine. So I just eventually slowly turned it over, and then we plan to do an exit at 3 years with the refinance, and then just continue to hold it.
Okay, so Mayu, you're going to ask something.
No,
I think we're probably thinking the same thing.
I don't know. I was going to say, why wait the 3 years, right? Like, why not just refinance in stages?
Yeah, so mainly is because with my financing, I locked myself in with a 3-year term. And because it does take me some time to turn it over, and with the banks, with the appraisers, sometimes they want to see minimum 6 months, usually a year of expenses. Yeah. I wanted to be able to have that history. So it was going to take me, so this August, it'll be 2 years. So my goal is by this August, I was going to have the income where I wanted to. And I also wanted to have time for them to see that utilities have dropped, because I had gone in and put in heat pumps to replace some of the electrical baseboard heat, which during the winter months went up as high as $200 a month. And now with the new heat pumps, I've seen it drop as low as $80 a month during the winter. So I want them to see that history of lowered expenses, higher income, so I can get the best appraisal.
Then my second question is going to be, why not stagger the rent increases and the unit turnovers, right? Because that's essentially the approach that I went with in New Brunswick. I was like, rather than getting, say, like 7 or 8 units vacant at the same time, contractors have to deal with like renovating all of them. You're hit with vacancies. I'll just do 2 at a time, right? So I serve rent increases for 2 once I know they're going to leave or not. But the problem with that is like, this entire thing is going to take me 12 months when I really could have done it using Steven's approach in like 6 months or so, right? So is that essentially it? You just want to get it done faster?
So Mayu, it actually did turn out to be a slow turnover, like what you said. At most, I only ever had 3 units vacant. And then it was kind of just one at a time as we went. So my vacancy, the lowest it got to was only 4 units that were vacant at once. For the rest of the time, it was usually around 10 occupied, 2 vacants that were being worked on. And that is sort of the preferred strategy, especially once you get to these larger buildings, right? You do have a lot of debt service to cover. You do have high property taxes. So, you're going to be burning through a lot of cash. You're going to have to raise a lot more, like in reserves, if you just completely empty the building.
So actually what I was going to ask is just to educate our audience a bit. We're not allowed to do that in Ontario. We don't buy a building and just serve everyone with rent increases, right? So maybe chime in a bit on the landlord tenant. Is this still the LTB down in, in New Brunswick as well, right? There's their own tenant board. Like, what are the regulations there? Can you just turn over tenants and just increase rents whenever?
Sure. Yeah, that's a great question, Austin. So for me, like my first criteria whenever I was looking at any markets for real estate was, number one, what is the legislation like? Is it pro landlord or pro tenant? Because the way I see it, if it's in a very pro tenant province or state, you're starting off the competition with one arm tied behind your back, right? Your top line is already capped. And say if we hit a point of higher than expected inflation, your expenses will show up much faster than what your income is going to come up by, right? So it just doesn't make sense to me to put yourself at that disadvantage, right? I know lots of your audience probably invest in Ontario, and you guys make it work in your own way, but for me, it's just an additional headache I don't want to deal with. So in New Brunswick, the way the laws work is it is much more, I would say it's fairly neutral. It's probably what it should be. So there's no rent caps as to how much you can raise it by. So you're just basically capped by the free market, right? What competitors are willing to offer. And there's no rules about, you have to be asking tenants to leave for yourself to move in or immediate family to move in, right? So if their lease ends, you can just ask them to leave because you don't want to renew it, right? You can also, if it's on a month-to-month, you can give them the appropriate 2 or 3 months notice and ask them to leave, right? So it's much more like, to me, it's the way things should be, because all the markets I've invested in Arizona, in Georgia, and New Brunswick, they've all been like that. So to me, that's like, when I hear stories of guys in Ontario and BC, they're like, I can't get my tenant out. And I'm just like, it doesn't make sense. Like, I remember I was talking to my manager in Georgia, and she was telling me that, if the tenant doesn't pay on the 1st, they lay on the 5th, and by the 15th, they've already got a court date to basically to go in front of a judge and be like, and ask, hey, why are you not paying rent? And, they can't hold rent back for you not doing repairs. They can't be like, oh, the landlord is mean to me, I'm not paying rent. It's just, did you pay or not? If you didn't, here's your eviction notice. And then another 15 days later, the sheriff will come and physically remove them, right? So it's like any other service, right? Between you, the landlord, and the tenant. It's a contract. You guys both agreed. If you don't hold up your end of agreement, it's just, okay, things are laid out as to what the repercussions are.
Okay, so that makes a lot of sense. So what I'm thinking now is that the next logical thought is that, it must be very easy to burn apartment buildings in Moncton if you can easily turn over tenants. I know for a fact that that's not true. It is difficult to find deals, but why is that not the logic? Why would anyone have an underperforming building in that city, right? It's totally. Just super easy to turn around.
Yeah, no, that's a great question, Austin. And honestly, I'm asking myself that. Or I was asking myself that too. And I think people have caught on. That's why there's been a flood of buyers coming in from BC and Ontario into New Brunswick. But it also comes down to there just being a large capital cost being required, right? If you want to turn over a unit properly, I'm seeing usually on average somewhere between $15,000 to $20,000 to turn over properly, to make sure the mold is gone. Because there's always mold in the bathroom in these like 1970s, 1980s apartments. To make sure I put in to make sure I freshen up the common areas, put in a dash of paint on the outside, right? All that, it really adds up with these buildings. So, there's also a lot of owners who just own these buildings for a very long time, and they're just comfortable with it, right? Maybe they bought the building for $150,000, like on a 4 or 5 units. They're making $3,000 a month in rents. They don't really care. Like, they don't want to disturb their peace. They're fine with it.
That makes a lot of sense.
There also seems to be a huge range on what market rents should be, right? Where like you have like one bedroom going for like 800 and like a street down, 2 streets down, like someone else decided to like put it up for 1,000 and they luckily got someone, right? So there seems to be like this huge like range, and like I could be wrong, Stephen, you probably know more than me there. But there seems to be a huge range even when you talk to different property managers in Moncton as to what is reasonable rent for like a 1 bedroom, right? And a lot of that is obviously driven also by the quality of the product. So like Stephen said, if you're sprucing it up and then you're re-renting out, that's great. But if you're not willing to put in the capital investment to renovate it, then you're probably not going to be able to lift that rent and like re-rent it out, right? Like people will just go somewhere else if they're living in like an old, outdated apartment, right?
Totally, yeah. And like part of the reason for that is because there has, so if you're not, for your listeners who aren't aware of what the rental rates have been like in Moncton, they've had very, very low vacancy, like in the 2% range for the last couple of years. So there was also a period where they had probably approximately, I think 8 years ago, where there was way too much overbuilding. So there was a point where vacancy hit 10% and it's been slowly coming down. But then for the last couple of years, it's been quite low. But because of how high vacancy had jumped for a couple of years, that kind of put a halt to like new construction, or it dropped significantly. Right. So now, because they're facing quite a crunch in supply of rental units, the price has just gone up. It's Econ 101, right? There's a low supply, excess demand. Lots of people started moving to New Brunswick, especially during COVID. So we've seen, the market's still trying to figure out how much a 1 bedroom should go for.
Mm-hmm. So what are cap rates going in those type of areas? Not the way you calculate cap rates, because obviously you're conservative, as all investors should be. But when a realtor markets it, what kind of cap rates are we seeing down at New Brunswick or Moncton?
Let's do this. When an appraiser appraises a property, what cap rates are they using?
Sure.
And what cap rates is a realtor claim?
So basically, with a product like a 1970s apartment building product that for instance, the 12 unit I described, right? I had a conversation with an appraiser I worked closely with within the last month. And I asked him, I'm like, hey, things have gone crazy. Have you started dropping the cap rates that you're appraising at? And he told me, no, we're still doing 7% cap rates on value, right? So the thing is, people are starting to buy now at 6% cap rates, right? It's trying to push up, so they'll buy at 6%. They'll put in a bunch of capital improvements, driveway income, and then maybe their money is working at like a 7.3% cap, right? But when they go to refinance, the bank is still only willing to do 7% the cap, right? So the problem, I see it as a problem, is people are willing to bid down the cap rate because they're like, oh my God, 6% cap? I can't get that anywhere else in Canada. I'll pay for that. So it's so prices for this product, it's risen to a point where it's getting very, very close to what the as repaired value should be, right? So there's a very, very minimal spread between what it's worth afterwards and how much you put in at the end, right? Or if anything, guys are almost paying sellers, so they have the right just to fix it up, to like make it that after repair value. You know what I mean?
Yeah.
So the way I see it is, unfortunately, that's quite a risky thing to do, right? Because if, say, rent growth slows down, rent drops, or if vacancy increases, all of a sudden these people, they're going to have a lot of cash tied up in it. Now they're still going to get say a 6% cap or like on their money, which is not a terrible return. They could probably hold it for a long time, but it's definitely going to be overpaying for at least how the local appraisers are appraising for.
Mm-hmm, mm-hmm. Yep, that makes a lot of sense. And I think that's just a reality of Canadian real estate as a whole. What you're seeing in Moncton is what we're seeing in Ontario. People are paying at caps that don't even make any sense. And what's even more terrible is that turning around tenants, as we stated, is significantly harder. So you're going to be holding onto your crappy cap for even longer. So there's even more risk. I'm sure it's the same in Alberta. We were interviewing Mark Loeffler and he was saying caps are 5%, which I find quite shocking. I thought it would be much higher, but it's just like a cap rate compression everywhere. Investors just with a lot of money are just trying to put their money in real estate.
Yeah. So one conversation I had with a representative from a local credit union that I work with in Moncton, he told me that this was a month or two ago. He got a call randomly out of the blue from a fund manager in Shanghai, was asking about property in Moncton. And he was like, Moncton is not an international city. Why are people like from China looking at like this small city in New Brunswick? Like it only has 145,000 people in population. Like in Ontario, that'd be considered a small town, right? So it's, I'm not an economist. I don't know what's going on in the world on that level, but there's basically a lot of money in the markets and they're looking to go somewhere. They're chasing yield. And I know maybe to someone who's not in Canada, Canadian real estate anywhere is Canadian real estate. So they start to view it almost with a similar lens, right? Which is concerning for, local, more local operators. I guess I can't call myself local, but it's a concern, right?
You started investing in Moncton like a year and a half ago. We talked a couple months ago, and obviously the Moncton market has absolutely like exploded like everywhere else in Canada and the world, right? But Moncton's interesting because like a lot of us we're not going there for like appreciation. We're going there strictly for cash flow, right? Like cash on cash return, the ability to borrow old properties, favorable landlord rules. So what are you doing now? What are your thoughts on the current local market in Moncton? Are you still buying there? And as I said, I know you said you have a 12 unit locked up, but are you still aggressively buying there? Or like, what's your outlook for the market in Moncton?
Yeah, that's funny you asked me this, Mayu, because if you asked me this a month ago, I'd be like, yeah, I'm still actively buying. I want to get it. But like recently I was reading this book. It's by a guy named Howard Marks. It's called The Most Important Thing. And it's a nice investing book. There's no like super secrets being revealed. But one of the things he did consistently talk about is just the importance of managing risks when you're investing, right? And to me right now, because of how bubbly the market has gone, my focus now is shifting more towards reducing the amount of risk I have and not trying to aggressively buy buildings, right? Because the way I finance my buildings is usually close to 100% financed somehow, right? Whether through seller financing, private seconds, or the like. So am I going to aggressively buy stuff? No. If the right deal comes up through like my local network, I'll absolutely jump on it. Like that 12 unit I'm buying. The reason I have it under contract right now is because I am actually putting a master lease agreement on it. So I'm going to buy it in 2022, January, because right now its income isn't quite at where it should be. So I told the owner, I'm like, hey, I'll give you a slightly higher price for what it's worth, but I got to take over management today, go send notices to all the tenants, increase the income, improve the operations, probably turn over half the building before I even buy it. And then when I buy it, he's also going to give me 20% seller financing. So the only reason I'm willing to pay more than what's worth right now is because of the returns I'm getting on it. So those are the deals I'd be willing to jump into, like those where, maybe with some creative structures, it actually makes sense. But otherwise, like I've not offered anything on the MLS in months, basically just because it's a waste of time for myself and my agent.
How much is the 12 bucks now? So that first one that you bought back in how much did you buy for back in 2018 or 19?
Yeah, so 2018, that one I bought for $715,000. So that was about $58 a door. This most recent one, I tied it up for $80,000.
That's still pretty good for Moncton. That's still really good for Moncton.
It's still really good, right? Like the way I see it is with these buildings, when I underwrite them, unless they're in exceptionally good condition, I just blanket say $20,000 a unit in repairs. So that includes the interior units plus a common area, right? Mm-hmm. And right now the ARV on these sort of buildings is coming in only at 100, maybe 105 per door. Yeah. So, there's not much spread there. The only reason I'm doing this is because I'm able to get in with very little money. So it just still makes sense.
So question, that book that you're reading, The Most Important Thing, right? Is that the title? Okay.
Yes.
What was the takeaway from that book that made you realize, okay, I'm going to kind of slow down on growth? Because it's like books always give some amazing insight, right? And I want to just kind of jump in your head and figure out like, what was it about that book where it made you feel like you needed to take the pedal off?
Yeah. So a lot of it was, I'm trying to think of the best way to explain it. So like he kind of, the way the book is structured is it's a guy he's this fund manager. And over the last like 2 or 3 decades, he's just been writing these almost little memos on his blog that he'll share with his investors. And this is a compilation of a lot of those thoughts, right? So a lot of these thoughts were written during the period of 2004 to 2008, right? Just when the US, things were getting really heated and really bubbly. And basically a lot of the attitudes, the investing attitudes that he had noticed with people back then are kind of reoccurring now. One of the things that he mentioned in the book that I liked was that obviously you can't predict the future, but you can observe what the current climate is now, right? And the way, when I look at the current investing climate in real estate, at least, right, we have fairly lax lending standards. They are tightening up in a week or so we'll see how that goes. But everyone wants to get in. People are super bullish on it. And right now, sellers are greedy. buyers can't get anything, and there's multiple bids everywhere. Like you guys have seen this across Canada, right? And then one of the and his thoughts were just that the truly, like in a rising market, a rising tide raises all boats, but it's only when the tide goes out that you can see who's swimming naked, right? So a true investor is one who's able to minimize his losses in the downturn. Anybody can make a ton of money in the up market, and sometimes the ones who make the most money, right, that everyone is like lauding them and say, hey, this guy's amazing. He's like tripling his money within 2 or 3 years. Yeah, that's great. But then when things turn sideways, he may also be the guy who loses the most, right? So it's very it's kind of very common sense things about like risk and reward.
You'd be surprised, man. I don't think real estate investors are known for being particularly risk adverse. The majority of real estate investors are not risk adverse, right? We're not, and they would like to say they are invest for cash flow and guess for cash flow, but cash flow, yes, I do agree it's a good risk mitigant, but you're still highly leveraged nonetheless, Totally.
And the thing is like the cash flow is disappearing, right? When in a market like New Brunswick, I feel like the cash flow is getting tight. Like I can't imagine how people in Ontario make it work, like where you guys are. Like I know you used to invest a lot in Windsor, right? Like, is there even any cash flow at this point? Like true cash flow when you underwrite properly. Yeah,
when you increase the interest rates, your cash flow will get very slim. At current interest rate environment, yeah, there is cash flow, but put it to 3 or 4%, you're probably neutral. And that you don't want to be neutral as well, because that's not risk adverse.
Exactly, right? Or like I'll see instances of people who will look at a deal and they'll say, hey, if I turn this into Airbnb or a student rental, I'm getting like a 7 cap on it. That's awesome. That's an amazing return. But the way I see it is like, hey, when you do short-term rental, that's a completely different business. You can't be underwriting it the same as a long-term long-term lease, right? Like the banks aren't stupid. There's a reason they don't lend a certain way. And I'm not saying that guys can't succeed. I've known lots of guys like on social media who do like Airbnb arbitrage, and they're making crazy returns. But it's like, say, the newbie who comes in there, and they get sold the idea that, hey, you buy this, this very expensive product. If you just make it into a student rental, you'll get this great cash flow on it. Like, yes, you can, but keep in mind that, you're really overpaying for a lot of work that you have to do, and you're buying more of an active business than you are like an investment.
But in those businesses, you get rewarded for the additional risk that you take when you implement a student housing or you implement Airbnb, right? Higher risk, higher return, that makes sense. But I'd echo what Stephen was saying, is that cash flow is getting squeezed in a lot of these markets. Like when I went to New Brunswick and when I bought my 2 property there, it was because cash flow was whatever it was. I don't remember my numbers now, right? But let's just call it like $1,000, right? And then when it dropped to like $500-600, I'm like, New Brunswick's not appreciating the same as example BC or Ontario. Your return is in the cash flow and the ability to burn and get the cash on cash return. Once you squeeze that return, is the return worth the risk that you're taking, right? Like as Stephen mentioned, if it hits 10% vacancy in another 5 or 10 years, like where's my reward for taking that risk, right? And as investors, we might not be risk averse, but we are getting rewarded for the risk that we're taking. And the moment that reward stops is the moment that you kind of stop or decrease your investing, right? Or
absolutely. Mayu, you hit the nail on the head. Like you have to be compensated for the risk you're taking. And what I'm seeing in the market now is people are not being compensated for taking those risks.
One more thing, I feel I just enjoy talking about this topic.
We were way off topic on this.
I know, but this is like something that grinds my gears. Is that, and I think you mentioned this, Stephen, is about like seller financing. It's totally fine. But sometimes people get 80% loan to value from the bank and get 20% from the seller, right? As a vendor take back. And they're like, oh, I'm going to overpay a bit more above market value because it's fully leveraged. And they might say like the seller is going to hold the mortgage for 1 year. Well, what happens after that year is done? Do you have that 20%? Like if you don't have that 20%, then you got to pay the seller back. What happens if prices take a dip? Right? What happened to prices stay flat? Because you got to still pay the fees to, discharge the mortgage that the seller registered, second entitled, so on and so forth. But people are not that far-fetched looking. They're just looking for the acquisition today, which is concerning, right? They're almost everyone is probably going to be like, oh, upward appreciation over the next 5 years. Well, what happens from now until those 5 years? Do you think it's going to increase steadily? And if not, what's your game plan between now until then? Right. But yeah, we went a bit off topic. I just thought it was definitely like, I mean, Steven's passionate in the topic, we are as well. So why not?
Hey, all good, man. I love talking about this stuff. I hope you can tell.
All right, Steven. So I mean, let's get this back on topic. I think what a lot of people want to hear is, because I think you might be our first guest that's actually investing in New Brunswick, if I'm not mistaken. So what are the returns that you're actually getting? Like if you walk through a deal from purchase price, ideally like one of the most recent deals that you've done, walking through from purchase price to like what you're spending on renovations. I know we already touched on that, but your cash on cash return, your expectations for the BRRRR. That'll give a lot of our guests an idea of what to expect in Moncton. And yeah, I know Moncton is different from the rest of New Brunswick, but yeah.
Totally, man. Yeah. So, I'll go over this is a smaller deal that I'm working on. So this is going to be a full BRRRR where I'm anticipating pulling all my initial equity out of it. So it's a fourplex that I bought back in September of 2020. So when I bought it for $200,000 from a wholesaler. So he got it under contract for like $170,000. So he's making like a $30,000 wholesale fee on it. So good for him. But the way I saw it was I'm buying in at $50 a door. This building, I got it appraised at closing. I got a as is and as complete appraisal on it. So it appraised for, I think, $230 or $260 as is. But the as complete appraisal came in at $430. Right. So I told him what I thought the rents were going to be that my property manager told me about. So then I had this appraisal done. So I'm like, solid. Okay, I know exactly what's going to be once I complete it, not assuming there's any market appreciation. And
back up. How did you lock up the deal? Actually, let's get into that part, and then
it was a wholesaler who brought it to me.
Oh, okay, yeah, that was right. Yeah, that was right.
Yeah.
Sorry.
Yeah. So I anticipated renos. I was going to do like basically a thorough cosmetic reno of all the units and redo the roof and maybe repaint the building. So I was anticipating somewhere around $80,000 to $90,000 in renovation costs. That has since ballooned. I ended up completely gutting the top 3 units and found out there was no insulation. So we had to reinsulate everything, re-drywall the top 3 units. We found aluminum wiring, so we had to rip all that out and put it back in. I had a hobo break into the lock in the basement unit and steal some wiring, so I had to go fix that. So all in all, my costs did balloon quite a bit. We're probably looking at $120,000 to $230,000 in renos. So I'd be in for $200,000. After repairs, I'd be in for about, say, $330,000 to be on the higher side. Right. So I know my ARV is still $430,000, so I can get an 80% refinance on exit, which is solid. And then this one, I did bring in a JV partner for. So it was a classmate of mine, or not a classmate, but someone I knew from dentistry. So he put up all the down payment funds and renovation funds. And then the way we're doing it is on refinance, I was going to pay him out all of his initial capital plus like a preferred return. And then he maintains like a 20% indefinitely of all the cash flows and all the equity, right? Whereas I get 80% of the cash flow and equity. So I got to go in all in with none of my own money, and then I get a cash flowing asset at the back end of it, and hopefully a bit of refinance proceeds.
That's an interesting model.
Yeah, that's a perfect example of a joint venture that can be whatever you literally make it to be, right? He's giving you all the capital, but you're also giving him a preferred rate of return on the capital. So it's kind of like probably, I'm just going to assume like 6 to 7 or 8% or something like that. That way he can service the debt, because I'm assuming he's pulling from a student line of credit if he's your classmate or something. And then he continues to have a smaller stake, but he has a stake going on in perpetuity, which could be worth a good amount of money right down the road. So that's really interesting. What's your cash flow projections on a fourplex? So when a fourplex is ARVs at 430, what's your post refinance cash flow going to be on that? Roughly?
It's probably going to be somewhere around 150 a door, somewhere around there, 150 to 200. Right now, rents have jumped up. If we're able to exceed that a little bit, we'll get a bit more cash flow. So on a bill on a 4 unit, then we're talking about somewhere like 600 to maybe 700 a month in cash flow. And It's going to carry all its operating expenses.
That's awesome. Yeah, that's amazing, man. And I'm assuming the property appreciated even more than 430 since purchase, right?
Yeah, I can probably try and sell it for probably just under 500, especially because I put in all new everything.
That's pretty sweet, man.
I'm in it just for the long term, so I'll just hold it unless someone gives me like a crazy offer.
Yeah.
So going back to what we were talking about, like if that fourplex was at $600 a month cash, like true cash flow, right? Like not like the way that some people calculate cash flow, the way that Steven calculated, I'm sure it's like true cash flow. I know people that are buying fourplexes there in the high threes that need like 70 to 80 grand worth of work. And then like they're refinancing at 500. So that's $600 a month cash flow is really dropping to like somewhere around like 500, right? It's just like, at what point do you stop it, right? And that goes back to the topic that we were talking about before as well.
And you gutted your unit, eh? Like you said,
yes.
you actually gutted it. So man, everything's due.
Right down to the studs, exactly. Just on the top three, the basement, we still kept it, the original plumbing and wiring.
That's awesome, man. All right, Steven. So generally at this time in the podcast, we like to ask our guests 3 questions just to kind of get an idea of who you are. So our first question, Steven, is where are we going to be seeing you 5 years from now? Personal life, investing life, you going to be investing in none of it, or what's the plan?
Yeah, the cash flow is good there, right? No, so obviously I'll be focusing probably just more on family life, right? The reason I got into investing was to kind of build that financial freedom, just so I can make choices without the burden of like finances factoring into my decisions. I'm actually moving up north to rural BC for the next couple of years to work as a dentist. So hopefully by then I'll make it back to Vancouver. And then, just in terms of investing, I'm going to scale it back and try and be much more of a passive investor. I'll probably just hold on to what I got, sell off the underperforming assets, and move more into a passive role, and then find some entrepreneurial young guy, and then I'll throw my money at him.
When you said move up north, I was like, oh shit, he actually moving to
like literally Yellowknife or something.
Yeah, no, I think we're going to be about an hour and a half away from the Yukon, so pretty far up there.
Yeah, so that's interesting because like you essentially, I'm sure with all these like 50 units or so, you're relatively financially independent, right? So now you can kind of focus on doing the things you like. You can kind of live the lifestyle you want as well, and ultimately you were in veterinary school, or no, dental school, right?
Dental school, yeah, exactly.
Yeah, so I'm sure that must be something you like.
It's funny how every high performer wants to take the passive role after, eh? It's a lot of work, man, doing the active shit. It's not all glory.
It is, but you know what? It's a way for like an average dude to really scale up, right? To create wealth that wasn't there. So that's why we're doing it.
Me and Austin were talking about this yesterday, right? Like at what point do you stop? At what point is enough, right? Like, do we want to get to like 100 doors? And what is the point of getting to 100 doors? Is it just like an ego thing, or like, what are we trying to do here, right? And
I'm telling you, man, the goalposts keep moving. They really keep moving.
Yeah, they do. It's like, it's never enough, right? Cool.
Okay. Yeah. And question number 2 is, if you won $10 million and you had 7 days to spend it, not all of it can be spent on real estate, what would you do with it?
Okay. Yeah. I'm guessing you guys want like more of a creative answer. I don't know. I'd probably buy a ticket to like Virgin Galactic, go to space, check it out, bring some friends with me. I don't know, build my own gym just so like I can just work out with my buddies, because I love the energy when, you have buddies in the gym. And
buy one house in Vancouver, just one.
Yeah, one house in
just
Vancouver. I'll buy a little garage.
Yeah, buy a garage. That's awesome, man. Yeah, I don't even know. Like, are the tickets to space?
I think I saw something about like 250 grand, and you can reserve a spot.
Holy shit!
I don't want to be the first guy, but maybe I'll be like the 10th trip to go up there.
He's been talking about it for years, so you probably wouldn't be able to experience that for a while. But all right, Steven, our last question: if you could have dinner with anyone, dead or alive, who would you choose and why?
Dead or alive? I think this is probably going to be an unconventional one, but Marcus Aurelius. He was like a Roman emperor, like way back then, and he was like known as the philosopher king. Like, and he really made the school of philosophy of Stoicism really popular. And I don't know, I think he'd be really cool to pick the brains of the guy who ruled over a large part of the known world, and but yet did it with a very interesting perspective on the world.
Steven's a very deep dude.
Yeah.
Very deep dude. You know, all of the quotes we post on Instagram, he wants to meet those guys who created those quotes.
Yeah.
That's so funny. Awesome, man. Yeah, no, thank you for joining us in today's podcast. You're doing amazing things. You're the definition of an action taker. You know, you started at a young age. And you were sophisticated. It seemed like you were pretty sophisticated right off the bat. You surrounded yourself with the right people. You took all of the right steps, and you didn't care to invest long distance, right? Like most people are afraid to invest 2 or 3 hours away from the city. You're investing like probably 5-hour flight away from your hometown, right? So that's That's crazy, man. I applaud you for all of the success you have. I know you're going to continue doing great things. And if people want to reach out to you, how can they do so?
Instagram's probably the best way. So just follow me at Stephen Huang, RE for real estate. And just send me a message if you want to chat. I love talking about this stuff.
Awesome, man. Appreciate you jumping on. And for those who enjoyed this episode, make sure to like, comment, share it with a friend, go on iTunes, give it a 5-star rating. Helps bring amazing guests like Steven out here. And until next time, everyone, invest smarter and live better.